I love people who've been in an industry for a while, seen some different things. The private credit industry, it seems like nonstop that we've been talking about for several years right now. It's grown. It's massive. I'm just curious how in terms of the evolution from when it first started, when you were first involved, is this for better or for worse?
My God, it's changed so much. We took the company public at Fifth Street in 2008. Since then, everything's changed. Back then, we were 0.7 times levered. Today, you're 1.2 times levered. Back then...
Almost double.
Yeah. A lot more leverage. EBITDA. Everybody says they're at EBITDA 5 times leverage. Today, it's really, I think, 7. And you saw that in an S&P report that basically said, look, you have a lot of add backs. So many things. I mean, we can't do it all today, but so many things have changed to add leverage, to maybe change the quality of the assets. And then it became very frothy. We all know it was a bubble. Lots of assets came in, interval funds opened a new client base, and now the bubble's bursting, which is kind of normal for the industry.
Well, that's a big statement, because I think people would say we see cracks. What do you mean it's bursting? Because it's like, are you saying that there's a lot more to come, or in terms of redemptions, or tell me, go deeper in that.
Go deeper into it?
Yeah.
Well, it's always happens, the industry cycles. Back then, when we started, a company called American Capital, Allied Capital, and GE Capital were the 3 leaders. Today, none of them exist, right? 10 years later, they don't exist.
Right.
So that
GE Capital was lauded.
Amazing, that's right.
In a big way, yeah.
Exactly. And so that bubble, that created a bubble, and that bubble burst. And that bubble burst because liquidity came out of the system in 2008. Which gave birth to my little company that we started, and we got to come in at that vintage. So today, it's a similar thing happening. The industry will be here. Look, it's a good industry. It's an institutional industry. So I'm not saying the industry goes away. It's just, and it has a good purpose. It's just, it's not going to be quite this big.
What's the cause of the bubble bursting this time?
Well, it's usually liquidity draining from a system. So that's what you're seeing here in the redemptions. You're seeing liquidity drain. Sometimes you see a recession. Sometimes you see, investors wanting their capital or hoarding capital. Sometimes in 2008, you see 2020, right? You see a dislocation.
But the investor appetite for capital, what's prompting that right now? Is it concerns about AI and software, for example, and a lot of the software exposure that these funds have? Like, what is it that's prompting investors to say, actually, we want our money back?
So I think a smart person on Bloomberg, maybe it was Blank Fine, I was watching the clip, and he goes, what happens in history doesn't repeat itself, but it rhymes.
Right.
It's rhyming, right? So you never know what bursts a bubble, but it usually is a liquidity drain. It can be the AI causing more dislocation, and it could be the PIK securities. I mean, I think the people became very complacent. You have things called PIK toggles. I know that's difficult, but think payment in kind. So in other words, they really don't collect cash. They collect more debt. And so all of these different tools, lack of covenants. People say they have a covenant. A covenant is like, think about it, brakes on a car. So you're running a car at 65 miles an hour, and lately they've been doing with no brakes. So that's kind of scary. And so all of these different changes in the market since you and I spoke last, maybe 8-10 years ago.
A long time ago, I know.
Yeah.
It's made a difference. Well, I think it's a conversation we've had a lot, Tim and I have, certainly around this table, and that just this idea that the industry grew so much. There were assets chasing, deals to be made. There was just the hope of, the returns of the past that would continue. And when you have so much money chasing maybe a certain amount of deals, you're going to tend to put that money into deals that maybe aren't so wonderful. And that deal that might look great in a zero interest rate environment or really low, okay, but doesn't look the same way today. And that's what we're starting to see.
And will interest rates bail them out? Like I saw you.
Probably not.
Now we think probably not, right? Now it's forecasted to even go the other way. So people were hoping, stay alive till 25, and
I want to throw something on, and this is from one of our producers, Talia, who shared this story with me, and we wanted to bring it up with you.
Sure.
Goldman Sachs and JP Morgan are offering hedge fund clients ways to bet against the private credit market. They have assembled baskets of listed companies with exposure to this space, including European financial institutions and alternative managers. Private credit market, of course, facing pressure. We've heard that story before, right? Betting against something.
Sure.
Do you think that's a telling sign? Or not necessarily?
I think taking a blanket approach is not the right approach. Yeah, I hate painting the same brush with everybody. There are good performers in private credit. when the fire burns, the forest burns, the new trees can grow. Hopefully we get to invest now in the new lower middle market's empty.
Right.
So we get to invest in a very exciting part where they haven't had good returns for the last 7 years.
So you pick up things at a really low price? Is that what you're saying, or no?
We're coming into deals and getting another 400 basis points, which pays for that risk-adjusted return, which wasn't there a year ago.
Right.
So now is a good time to invest. So there will be winners. But I think that same fire, right, will burn some trees, and there will be some trees that remain. And there's some really good players in the market.
So what about your portfolio and your private credit portfolio right now? What are you seeing in there?
Well, the good news is I'm just building it in the last 4 months.
So it's a good time to build
your
it?
private credit exposure you're just building in the last 4 months?
I sold our Fifth Street to Oaktree in 2017. I personally owned about $100 million of Oaktree stock. I've sold all that a couple of years ago. They did very well, actually, a couple of years ago. That stock has gone down a lot. And today, I haven't invested at all in private credit. I just started again. And we always invest our money at TCG alongside our investors. So I'm the largest investor in every fund. I own 25 to 30% of the fund. So we put our money where our mouth is. Mm-hmm. And now I think it's a really exciting time to invest in the lower middle market.
Where specifically?
I mean, you can invest across assets. You can do asset-backed stuff.
Yeah.
You can even do some technology. One of the companies we invested in goes into a company that uses Walmart and Target and trades with them, right? They're one of the suppliers. And they always mismatch invoices. So they go and they say, I'll save you 25%. And if they do, they get 25 or 30% of the money they save them. And that's a great business model. And I think AI, going back to your other conversation about AI, is helping them. Because the smaller companies, the lower middle market, can often be helped by AI to compete with even bigger ones.
Len, real quickly, just got about 40 seconds.
Sure.
What about in the software space that's been beaten up? Is that not something you want to touch? Is it just not in that lower middle market area? I'm just curious.
I'm not a software expert. 30% of our stuff was technology. So I believe, even though I'm not a software expert, that about 50% have trouble and 50% may do very well. I'm just not smart enough to be in the right 50%, so we're not going to play.
You want to know what you're investing in. Try to understand it. Yeah.
You have to be an expert to invest in software here.